Hello and welcome to this session in which we will discuss income shifting as a tax strategy for corporation. What is income shifting? Or what is shifting? What's the shifting of income? It means transferring the income from one entity to another. Now, why would you do that? You want to transfer the income to the entity that pays lower taxes. If you can do that legally, therefore the overall tax bill for the entity is lower. So this is what income shifting entails. So it's a method used to manage how and where income, deduction, and losses are recorded, and who's responsible for those, because the person responsible for those will either enjoy the benefit or pay the tax. So the goal of these strategies is to do what? Is to take advantage of varying of different tax rate that exist between different geographical areas, between different cities, countries, state, and between different type of entities, a corporation versus the shareholder. And this is what we will discuss here. Whether you operate in a different geographical area, how can you benefit in income shifting, or shift the income between the corporation and its shareholder. And by doing so, individuals or businesses can potentially lower their tax liability. And this is the whole purpose. The whole purpose of income shifting, legally, of course, is to lower your tax liability. And this could be achieved by moving taxable income to places, to jurisdiction or entities with lower tax rate, while allocating deduction and losses to those with the higher tax rate. So it's not only you want to move income, if you could move expenses to higher tax jurisdiction, because the higher the tax jurisdiction, the more benefit. Remember, the deduction, the higher the tax rate, the higher is the benefit. So if you have a deduction of $100 and a tax rate of 20, your savings are $20. If you have $100 and the tax rate is 30, your tax savings are $30. This is what we will discuss in this session: income shifting between jurisdictions, between geographical area, and income shifting between the corporation and its shareholders. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course, such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Starting with income shifting when it comes to jurisdiction means geographical area. So income shifting often involves choosing the most favorable geographical location for recognizing income or expenses to reduce liability. So if California has a high tax, you want to look maybe for another state, Montana or Michigan or some other state, or Texas, that will give you a lower tax rate. So in essence, the aim is to record income in places with lower tax rate and shift expenses, allocate expenses in areas of a higher tax rate. Again, as long as it's legal, because recently the government has been catching up with these tactics. So as long as it's legal, there's a potential benefit by doing so. But again, the law has been changing, especially when it comes to transfer pricing. And the reason we have this exist, especially in the US, because each state, it's independent and has its own tax rate, and some states have offered a very low or even no corporate income tax rate. But again, when you move over there, when there is no corporate income tax rate, there might be other consideration you want to factor in. For example, they may not have the people, the talent that you need for your corporation. They may not have the logistics to ship your product. So that's why you have to take into account not only tax consideration, but because of this varying tax rate, this creates an attractive opportunities for businesses to relocate and expand their operation into lower tax states to take advantage of these tax benefit. And the overall purpose is for the company to grow, reduce your taxable income, and the company keep more cash on hand. Let's start with an example just to illustrate this concept. Let's assume Atlas Enterprise, a technology company, is currently based and operates exclusively in California, where the corporate income tax rate is 8.84%. This is the state. Due to a growing demand in the eastern US, Atlas is considering setting up a new office either in Texas or in Virginia, The Virginia is 6%, taxes has no corporate income tax rate. Also, the company predict that its taxable income would reach 15 million, with 60% attributed to California and 40% attributed to the new office location, whether you select Texas or you select Virginia. So let's go ahead and answer a few questions to kind of get a hold of this shifting of income to other jurisdiction. From a tax planning, should Atlas expand its operation to Texas or Virginia? Well, expanding it there is most advantageous location will be what? What do you think? Well, Texas will be. If the company apportioned, if the company allocate 40% of its income, which is that $6 million, well, that $6 million will be subject in taxes in the new state. So if you choose Texas, well, what's your tax bill on the state corporate level? 0. However, if the company chooses Virginia, it would need to pay a corporate income tax of $360,000 because for that $6 million, they have to pay 6% in Virginia. That's $360,000. What other tax planning strategy you might advise Atlas to do? Or, what would you say? Well, aside from the decision regarding the state for expansion, they should consider other strategies to optimize their tax situation. Okay, given that both Texas and Virginia offer lower corporate tax rate than California, well, you want to find legal ways to do what? To shift. Remember, of the 15 million right now, we're shifting 6 million out of the state. It means we have 9 million still in California that's subject to 8.84%. We want to find other places. This might involve strategic allocation of sales, property, and payroll, which are common factor in determining state income tax apportionment. And we talked about this, how to apportion income to various states. Also, California relative high corporate tax rate, we might do what? Because of that, relocate, move out the headquarters to a more favorable state. Now, bear in mind, once again, we have to take into account not only the tax rate, but other factors, operational logistics, talent pool availability. Do you need people with certain knowledge that you cannot find other than California? Market access. Do you have the market? Do you have then to ship the product back to California to sell it? Is it worth it? You have to look at other consideration. Now let's take a look at income shifting between the corporation and its owners, or the corporation and its employees if you pay them. But usually when you pay those employees, usually they are owners of the company to take the best advantage between the two. So income shifting strategies can also apply in transaction between a corporation and their owners, focusing on who's responsible for reporting the income. Once again, most likely we're dealing with owners who are also a manager in the company. They work for the company. So we have the company and we have the owner. What happens is the company might be able to transfer some income to the owners or vice versa. What is the most advantageous way in structuring these transactions? So the goal is to arrange for the party with the lower tax rate to carry the income. Within this framework, well, there are several tactics to achieve this because the goal is to shift the income. For example, a corporation might pay salaries to shareholders who also work for the company. Because you work for the company, you're a shareholder. Simply put, the shareholder and the company, in a sense, they're one entity. But if the shareholder is working as an employee, you can shift some income. And under this approach, not only the corporation with a tax-deductible expense for the salary. With this approach, not only provides the corporation with a tax-deductible expense for the salary, but also allow the shareholder employee to report their income at their personal tax rate, which might be, the benefit has to be lower than that of the corporate tax rate. Otherwise, you are shifting to the owner, and thus avoiding the double taxation that can occur on corporate profit, first tax at the corporate level, and then again at the individual level. So you can pay the employees/owner to do what? Reduce the taxable income at the C corporation. So another common method involves corporation leasing property from their shareholders or borrowing money from them. In this transaction also create a tax deductibility. For example, you are the owner. What you do is you rent your office space to your own company, or you rent an office building. And what happened to the corporation? The corporation will pay rent, will pay you rent. And when they pay you rent, they reduce their taxable income. These transactions create a tax-deductible expense for the corporation in form of rent, or if you lend them money, they pay you interest, while the income is taxed only once when it's received by the shareholder. So the shareholder don't have double taxation because the shareholder pay taxes only once. Again, this strategy helps in avoiding double taxation scenario as the corporation reduces its taxable income through deduction, legitimate deduction, and the shareholder report this income individually. But this way, the income is not taxed twice if it kept at the corporate level. For example, Jenna, a 30% shareholder in XYZ, and plays a key role in company's daily management. For her contribution, the company compensated her $150,000 in salary. The prevailing corporate rate is 21%. Let's see how would this help if you are paying someone salary, someone manager / owner. Okay, 30% owner is owner. Determine the overall tax impact for Jenna and XYZ if Jenna's personal marginal tax rate is 15 or 32. Now, before we even compute the numbers, what do you need to know? Well, the corporation will get a deduction at 21%. Jenna will have a taxable income at 15. Well, that's a good deal if her tax rate is 15. So you are shifting the income to Jenna for Jenna to pay on the taxes. That's a good deal. Think about it. If Jenna's tax rate is 32% and you shift $150,000 to her, she's going to have to pay 32% taxes on it, while the company only pays 21%. But again, we're ignoring the double taxation factor, but we're going to see the net impact from a tax perspective. So what's the net income tax savings or tax obligation? So the tax saving for XYZ, if they pay her 150, and here when we say pay, I use the word shift so you understand it's within the strategy. If they pay Jenna 150,000, the company will deduct 21%. Therefore, the tax savings for the company is 31,500 because they had an expense of 150. Now, this expense is shifted in form of income to Jenna. Jenna would receive the money. Say, okay, Jenna, you'll have 150,000 salary income multiplied by 15%, and Jenna will have to pay 22,500. So notice, overall, if we net them out, the company had a savings of a tax savings of 31,000. Jenna had to pay 22,500. Between the two, there are a net savings of $9,000. Net savings of $9,000 between the two. Now, if Jenna tax rate is 32%, Jenna will have to pay 48,000. Then it's not a benefit here. What's going to happen, they're shifting the burden of taxation to Jenna, and she's paying higher taxes, which is the difference is 16,500 in taxes because they paid her 150,000. So you have to be careful how the shifting takes place. Again, here we are assuming Jenna is a shareholder, manager, and there's some room to kind of decide on the salary. When it comes to non-cash distribution, when the company distributes something other than cash, the corporation has to be careful when dealing with non-cash transaction, because these activities can lead to unexpected tax bill for both the corporation and the shareholder. So non-cash distribution, you have to understand the consequences, especially there are consequences that are unexpected. For example, when a shareholder contributes non-cash asset that has increased in value, they could face a tax obligation on the gain if they don't meet Section 351 contribution. What's Section 351? Section 351 means even if you have a gain, you don't have to pay taxes on the gain. Section 351 generally requires that post the transfer, after the transfer, the contributor, that means the people that contributed money, have control of at least 80% of the corporation to avoid recognizing a gain. For Section 351 to kick in, you want to make sure when this individual contributed the asset to the corporation, it's part of Section 351, which means after the transfer, after the contribution, the shareholder or shareholders, whoever contributing this asset, they can be a group, control 80% to avoid recognizing a gain. That's important, and you need to be familiar with Section 351. Also about non-cash distribution, also the corporation could hand out non-cash assets. When the corporation, now it's the other way, the corporation is given non-cash asset to the shareholder that have appreciated in value. Now this asset appreciated in value and the corporation is not dissolving, so it's not like they're going out of business. Well, under those circumstances, the corporation will have to do what? Report the gain on those assets at the time of the distribution. And obviously those rules are in place to prevent what? The avoidance of tax on the appreciation asset by transferring them through the corporation to its shareholder without a tax event. And that's why we have those rules. Otherwise, what the corporation would do, if they have an asset and it appreciated in value, they can transfer it to the shareholder. And if there's no tax consequences, the shareholder gets it and they don't have to pay. The corporation will not pay any taxes. Also, we have to be aware of gain by shareholders. Let's look at an example to illustrate this concept. Let's assume XYZ Corporation has Sally, a 2% shareholder, contributing a piece of artwork to the corporation. Well, she's a 2% shareholder. The artwork has a cost to Sally of 15 and a fair market value of 100. What does that mean? It means it's an appreciated property. Well, 85,000. There's a gain of 85,000. Let's see what's going to happen post-contribution. In return for this contribution, Sally received additional shares, increasing her stake to 6%. Well, is this Section 351? And the answer is no. In this scenario, she does not meet Section 351 because post-contribution, Sally did not control 80% of XYZ Corporation. This is when Section 351 will kick in. What does that mean? It means that the deferral provision of Section 351 does not apply, and the gain by the shareholder is taxed, and the gain is here, 85,000. It's as if Sally sold this asset to the corporation, which is, she's receiving a hefty tax bill on 85,000. So Sally is required to recognize 85,000, which is calculated by taking the fair market value minus the basis. And this gain represents the increase in value, which is it's taxable. It's taxable. It's as if she sold it, which she did not. She doesn't even have the cash to pay the tax. So you're looking at 85,000, depending on her tax rate. Let's assume 25% or 27%. That's a hefty tax bill that she may not be aware of. And the reason is because she did not transfer this property, and control 80%, and she did not transfer it in a part of a group transfer to control 80%. And sometimes we could have recognition of gain by corporation and income to shareholders. For example, ABC, a corporation with 10-year history, decide to distribute a piece of commercial real estate to Clara, who owns 3% of the company's shares. The real estate has a current value of 150, and the basis for the company is 20,000. Again, we are distributing an appreciated asset. In this case, what happened is the company will have to recognize a gain of 130, the difference between the fair market value and the basis. And guess what? This gain is taxable to ABC company. Why? Because it's appreciated property and that it was held by the corporation. For Clara, the shareholder, she acquires a real estate with a tax basis of 150, that's her the basis is the fair market value. So as far as she's concerned, she received this. Her basis is 150. Also, what does she have to report? Dividend. That's a form of a dividend. Clara may need to report this income of 150 as dividend. And that also depends on, we're assuming that ABC will have enough EN profit at the time to be considered dividend. Take a look at this multiple choice question from farhatlectures.com. Which of the following best describe the purpose of income shifting strategy? So why do you shift income? Okay. D, to ensure income is taxed at the highest level? Absolutely not. You want income to be taxed at the lowest possible level. To simplify the tax reporting process for multinational corporation? Not at all. Income shifting might complicate tax reporting because you're dealing with many jurisdictions, so that's not the purpose of it. Is it to take advantage of the difference in tax rate across jurisdiction and entities? Possible, yes, that's a good answer. Looked like a good answer. To increase the overall tax liability for corporation and their shareholder? Do you really want to increase it? Do you want to decrease it? The A is out. Therefore, the best choice is B. The reason you participate in income shifting, you conduct income shifting strategies is to take advantage of differences in tax rate across geographical areas, between entities, between shareholder and corporation. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you whether you're studying for your CPA exam, enrolled agent, tax course, or any other professional certification. Invest in yourself. Good luck, study hard, and of course, stay safe.